Welcome to this special edition of IG Live, our monthly look at the release of US jobs and on-farm payrolls figure. We are looking today for a print of around about 205,000. The spread there on the Bloomberg terminal suggests anything between 150,000 to 240,000 jobs having been created in the month of February. We're looking there for a cut in the unemployment rate down from 4.1 to 4%. We are looking for average hourly earnings to come in month on month 0.2%. A year-on-year reading of 2.8%. Now that would be down from the 2.9% reading that we saw last month. Recently we've had the first indications of the leanings of the new Fed chairman, Jerome Powell, and the consensus seems to have been that, if anything, he's delivering a more hawkish rhetoric around the rate outlook than that we've been seeing from his predecessor, Janet Yellen. Will today's figures make any difference to his leanings on that? We are taking a look at the markets ahead of this number. Just want to quickly refer, if I can, to what's happening on some of these markets. The dollar basket trading at 89.90. We're off the lows. Recently, we saw the low print there in the middle of February at 87.83. We're seeing 10-year yields creep up, currently trading at 2.87%, which seemed to be one of the issues around the recent drop in the equity markets, worried about the upward march of these yields. Quick snapshot of where we are in some of the other markets going into the numbers today. I want to go first of all with some of the other foreign exchange markets with a look at this trade in the dollar, euro dollar. We're currently trading below recent support at 122.96, currently trading 122.85 as we go into these numbers today, and a snapshot as well as to where we are on these equity markets. And I want to bring up just a look at the US 500 or the S&P 500 trading at the moment 27.34. This is a 1 hour chart. Going in today's trade, you can see a slight pullback as we head into these figures out today, but much more, of course, than just these non-farm payroll figures in the mix in the markets today. We have the Trump tariffs on steel and aluminium, and also the news overnight, of course, coming through that North Korea is quite prepared to speak to America about the future of nuclear in the Korean Peninsula. Chris Beecham is joining us here in the studio. He'll be with us in just a moment. Chris, good to see you again. Back with you in just a minute. Also, I want to take a look as well at these markets with our guest for this next 10 minutes. Is Luke Hickmore, Senior Investment Manager at Aberdeen Standard Investments. Luke, good day to you. What do you see as the risks to today's release?
If we see this wage number staying over 3%, I think that's a big risk markets could face, and it would really get the ball rolling about how fast and how high ultimately US interest rates go, and whether inflation's a problem coming through as well. So that for me is a key number today.
Okay, in terms of the market reaction today, as I say, going into these numbers, we have at the back of our mind, of course, other matters to consider, not just non-farm payrolls. In terms of the sort of market trades coming out of these numbers today, what do you be watching for particularly?
Well, as I said, I think if we see that on the upside in terms of wage rises, that's going to be a spook for the market. We could see risk assets sell off. Alternatively, if we see this calm down a little bit, which is actually our central case, we could see market continue to recover from the bout of volatility that we saw in early February. That, I think, is the base case we should expect. Okay, all right, Luke, stay with us just a minute. As I said, got Chris here in the studio as well. Chris, for you, what's the trade going into these figures? As I said, if anything, we've got a slightly bullish outlook so far as the Bloomberg terminal is concerned. That 205,000 comes off the back of a 200,000 reading earlier in the week. We saw a stronger than expected ADP number out, of course, midweek. And of course, we always had to ask the question, is there a steer given through from that ADP reading?
What you've seen is quite a bit of resilience in the US dollar over the past week, and I think that's certainly the one to watch for. So you're looking at the likes of euro dollar. We've seen a lot of strength coming through, given the ECB's slight commitment to more, or not more, but continued easing, which maybe surprised people. US 500, keep an eye on this one because it's done its best to recover this week. It's still a bit of a job still to come, I think, in terms of a rally, but the further improvement in the economy, and indeed even in wages, with all that questions over tightening and inflation, should still be supportive of stock market here in the US that's been very strong over the past few years.
Yeah, okay, we've got about 30 seconds seconds. Chris, thanks indeed for that. 30 seconds to go until the release of these figures out today. 205,000 is the number that we're looking for. With anything between 150 and 240,000 is the spread of economists that have been polled by Bloomberg recently on those numbers. And we're looking for a print of 4% on the number, the unemployment rate. And we're looking for a 0.2% reading average hourly earnings month on month, 2.8% for the year-on-year figures. Just around about the time we're expecting these numbers to come through, and also, of course, looking as well for any revisions. Right, okay, 313,000 jobs having been created in the US economy in the month of February. Now, this is way off the top of expectations. As I said, 240,000 was the figure we'd been looking for. Let me just quickly bring up a chart while we're talking through these numbers of what's happening with the euro dollar. I want to bring through a chart which has given us some indications as to a 3-minute chart on this to give you a reading of what's happening. We have the previous reading revised up. I want to quickly run through some of these other figures as well. We've got the unemployment rate at 4.1%. Now, it's not gone down as we had expected, down to 4%. Average hourly earnings coming through with a weaker than expected 0.1% month on month and a weaker than expected year-on-year figure of 2.6%. Just to quickly reiterate this, a 200,000 reading, 205,000 reading we were expecting on the numbers. We got 313,000. So the surprise on that is in excess of 100,000 jobs over the expectations of economists polled recently by Bloomberg. Now, on the surface of it, that would appear to be a very bullish number, but staying with this chart here for the euro dollar, we're now trading lower for the euro against that dollar. We have that weaker than expected average hourly earnings number coming through, which I think is could well be an interesting one to look for. As Chris was saying, this is an important part of this jobs release. Let's go to the IG trading floor and catch up with William Croft, who joins us now. Willis, what are you looking at in terms of the flows? Clearly this is a far stronger than expected baseline number, but we have a weaker than expected figure for average hourly earnings. Oh, it seems like we've lost Willis Croft from the trading floor on those figures. Let's see if we can catch up with our guest, and Luke Hickmore, who is with us still from Edinburgh. Luke, what do you make of these numbers? 313,000, that's a lot more. And as we were saying just after we spoke to you, Chris and I were talking about the ADP number coming in far stronger than expected midweek.
Yeah, so I think the actual headline number tends to be a bit of a random number generator. I think the really key stuff here is that 2.6, I think you said, for average hourly earnings. 2.6,
yes, so 2.8% reading year on year. Well, I think it was expected,
2.6, really important.
We got 2.6, yeah.
Yeah. So I think there's a lot of seasonal factors go into this. January numbers were very impacted by some pretty awful weather. So all those employees coming back into work as we came out of the bad weather in the US and into February, you know, this was going to be a big number. That is a surprise, but it's good to see wages didn't rise with it. That should reduce some of the concerns the markets had about inflation, about the pace of interest rates. I think that's probably a risk on from an equity perspective, and maybe a little bit more support for treasuries here as well, which would imply the dollar may be flat to a little bit better by the end of the day.
Right, okay, Luke, back with you in just a minute. I do want to pick up with our trading floor if we can, and Willis Croft. Willis, also watching as we go to you and talk about flows, I'm looking as well at the S&P 500. We got an uptick in the position we're at the moment for the S&P 500. We are at, what is it, highs not seen now since the 28th of February. Willis Croft with us now from the trading floor. What are you watching in terms of flows?
Hi Joe. Yeah, it's a bit of a mixed bag really. As mentioned, the numbers, obviously, headline figures really positive, but the wage growth wasn't too significant. We're seeing a bit of buying in major indices. I think that's mainly following the initial jump of 100 points or so in the Dow when this number first came out. But apart from that, it's really kind of weighing up between the two, seeing a bit of selling in the dollar and some short-term kind of buying in equities at the moment.
Yeah, in terms of some of the other events, of course, as I said at the top of the show, we've got a number of other things to consider when looking at these markets today. Steel and aluminium sectors, of course, also what's happening on the Korean Peninsula. How are clients taking to the news that we saw out overnight from the US in terms of steel tariffs?
Yeah, look, I think the conversations I've been having with clients here is that we need to really wait until further details come out about this. Who's included, who's excluded. You know, since this first came out that these tariffs are going to be imposed, and that initial sell-off, we've actually seen the Dow kind of pretty resilient this week, rallying 400 to 500 points. An interesting development in the last kind of 24 hours or so is we've had the Asian Metals and Metal and Steel Association calling for retaliation tariffs. So for anyone that's interested in commodity trading, an interesting thing that I think to look at is something like soybeans, for example. It's the most valuable US export to China and could be primed for a kind of retaliation tariff from them.
Yeah, okay, all right. Willis, thanks indeed for joining us from the trading floor. Chris, I want to catch up with you before we get back to Luke very quickly. You were talking to me earlier about the interesting trade around the dollar-yen. This has seen a little bit of money going into the dollar. Just talk to us about what's happening with the dollar-yen chart.
I think if you look at it from this kind of daily perspective, it has done its best to rally off the lows. Now, obviously, look at this, the move, it's been December, it's almost been a one-way move. So there's a bit of work to do really before you can say maybe we've seen a short-term end to this downward move. But certainly I think the encouragement is that actually we're seeing dollar strength across the board, and this is probably the pair to watch for, at least in the short term. A lot of expectations that you might get a bit more dollar strength here on the back of heightened expectations of increased Fed tightening.
Yeah, okay, stay on this chart just for a minute if we can, because I want to bring up the 5-minute chart to give us a better idea as to the reaction that we've seen out of this. And you can see it, in fact, is pretty much all flat actually on this chart. We've got 5-minute candles. Give us an indication that from this number itself is not necessarily moving the markets too much, and as Luke was saying, expect the dollar flat. Luke, back to you if we can, and talk a little bit more about these markets and where things go from this point. You're a fixed income specialist. We've got yields currently 10-year 2.87%. Where do you see yields moving now? What do you see as the main driving force behind Fed policy as well?
So I think we're going to see the yield, where you live on the yield curve, actually differ quite a lot. So front end of the yield curve, the short end maturity, is really focusing around where interest rates go, which are going higher. And, you know, we could see as many as 6 or 7 interest rate rises over the next 2 years through to the end of 2019. That will push up front end rates quite dramatically in the US. Yeah. Absolutely. There's enough growth there, there's enough inflation, even at these kind of wage numbers, that you need to start getting interest rates up to prepare yourself for the next slowdown, which is probably 2 to 3 years away. And really yields are starting to reflect that. So I think by the end of 2019, I know it feels a long way off, we should be seeing 10-year US yields around 3.5%. I think that's probably where the terminal rate becomes quite clear in our mind. It might get a little higher than that, it might end up a little lower than that, but in that kind of context, I think. Now, if it happens over those 2 years, I'll be quite relaxed. A slow, steady rise in yields, I think, is quite healthy for the market from where we are now. That the risk is the market starts looking through all of this and pricing that a lot quicker. Today's not going to be the day that happens, fortunately.
What happens if we start pricing that a lot quicker? Where do you see most activity on the markets?
So if the market starts looking through, starts thinking about, you know, future problems and inflation really grabbing hold, then actually I think we'll start seeing credit spreads move wider, we'll start seeing credit underperform, and that could feed through into equities quite quickly. But that's certainly not our central case, which is for modestly higher yields in a slow pace. And credit fair value in equities in some places actually a pretty good investment at the moment.
Yeah, I want to return to the dollar if I can, and the impact of all this on the dollar. We've seen the dollar drop since the highs that we had back at the beginning of January 2017. So it's we've gone all the way down to what, 87, 83. Slight lift off from the bottom. Why is the dollar under so much pressure when you've got interest rate rises, as you were saying, 6 to 7 rate rises potentially, so far as you're concerned, in the US economy over the next 24 months?
Yeah, I think the drivers of what been moving the dollar around have changed. Whereas we might have looked at rate differentials in the past, at the moment it looks more about sucking money out of the US economy, trying to find growth in other assets like emerging markets, for example. And I think as we've had global growth, you've had this money pulled out of the US, and that's suppressed the dollar rate quite significantly over the last year in particular. As you say, 10 or so % over a 1 year period down. That could well continue. If what we're going to see is the growth from the US and growth from Asia continuing and Europe recovering, we could see medium-term pressure on the dollar continue from here.
Okay, well, look, Luke, we've got to leave it there, unfortunately, with you, but I know our time is up with you. But thanks indeed for joining us. Luke Hickmore is Senior Investment Manager at Aberdeen Standard Investments. Chris, it's interesting listening to what he was saying there, potentially about a weaker dollar. This has a lot of connectivity with commodity markets, doesn't it? The direction of the dollar. You get a dollar that's dropping further from where we are at the moment. I mean, what is the connection between that and gold, I should say, first of all, because there is a translation effect.
Yes, and stronger dollar, weaker gold is the way to look at this one, and it's has indeed played out over the course of the past week. So you'd expect further losses for gold. Momentum's been very weak in gold since the beginning of the year. If you look at something like the weekly chart, you can see how really rallies have been firmly sold into. We got that this week as well, really. We were trying to move higher, and then suddenly it's begun to peter out once again. So I think that's the way to look at this, is that we should expect lower gold prices, even as you've got the threat of higher inflation, if the dollar continues to push higher as it has done.
Yeah. Okay. All right. Let's look at some of these other markets. We were talking about the effects on the US equity markets. Just want to bring up a chart here of London's FTSE 100 and talk to what is happening. It doesn't look like actually I'm going to be able to bring up this chart. Unfortunately, we've seemed to have lost connection between my graph here and the output. But let me just talk to you about the European equity markets and where things are at the moment. FTSE 100 has taken a little bit of a lift. We were looking at a negative market going into today's trade, and that's where it was. Now, we've seen these numbers out today from the US, and all of a sudden, markets have turned positive.
Yes, and you've had 2% gains for the FTSE 100 since the lows on Wednesday, so it's not been a bad week for the index, certainly the second half of the week. Now, if you get a stronger dollar, that means you get a weaker pound, and that will help push the FTSE higher. If you look at performance for the indices, Europe and the UK have lagged far behind because of their strengthening currencies. They've been firmly under pressure. As a result, European markets have essentially gone nowhere for quite some time, but the FTSE finally catching a break because of this weaker pound, and that may well continue should this dollar continue to appreciate. And I think it's interesting. It makes sense to expect a weaker dollar over the longer term, but the risk is that everyone is now piled into the dollar on the short side, and that there's no one left to keep pushing it down. So one of those trends that's been going on a while. The question is, how much further does it have to run? And I should just be cautious with everyone beginning to think that a weaker dollar is just the natural outcome of current events.
Yeah, that was the FTSE 100. Of course, there's other events, of course, around Brexit and so forth. This is the US 500 lifting nicely off the recent lows. In fact, today we are past the 50-period moving average, and now what it appears to be some relatively clear air above where we are.
Yes, and you've got last week's high towards 2,800 still to breach, but you can see how that we've had our dose of volatility. We've had our substantial pullback, or correction if you call it that as well. It seems to have recovered now. Obviously we'll know only with time, but at the moment with the fundamentals of the economy and the fundamentals of earnings season still looking very, very strong, earnings proceeding nicely, margins very strong as well. That should support the market heading into the rest of the year.
So you'd be confident in a long position on the US 500, for example?
I think that'd be the way to go, really. The longer term trend is still up. You've seen the recovery. I think that it makes sense at this point in time. We shouldn't expect a sudden appearance of a bear market. Trends weaken before they turn, and we've not had that weakening yet.
Yeah. Okay. All right, Chris, thanks indeed for joining us. Luke Hickmore from the Edinburgh Camera at Aberdeen Standard Investments. He's unfortunately left us now, but thanks to him as well, and to Chris Beecham. That was a look at these non-farm payroll figures and some of the trades around there. Non-farm payrolls coming in at a far stronger than expected 313 in terms of the numbers themselves, 313,000. There was an uplift as well to the previous 200,000 reading to 239,000. So these are strong numbers right across the board. We've got the unemployment rate remaining at 4.1%. It had been expected to drop to 4%, but we also have, as a surprise on the downside, is that 2.6% print for average hourly earnings on a year-on-year basis, and that seems, at least according to our guests from Aberdeen Standard, as to one of the standout features of today's trade. The markets themselves taking a little bit of an uplift in terms of some of the moves at the equity end of the market spectrum, and in fact I think if we can bring up the numbers themselves, we are looking there for gains across the board so far as the start is concerned. These are the spreads you get on the IG platform now, and the dollar basket also a little bit of an uplift as well on from these figures out around about 15 minutes ago. We'll be back on Monday morning at 7:30. Hope you can join us there for that on the IG platform for Monday's early morning call.
The new IG trading platform. Fewer clicks, flexible layouts and time-saving settings. Split charts across multiple time frames and discover price change alerts, orders to part close, an integrated Twitter feed and more. Try IG trading now at IG.com.